Craig Bolanos joins us again, the co-founder and wealth advisor at VestGen Wealth Partners. GetRetiredStayRetired.com is his website. Hi, Craig. Welcome back to the show.
Be with you. Stock markets at all-time highs. The K-shaped economy persists. But listen, I think everything's A-okay.
Wait a minute. The K-shaped economy persists is a good thing?
Well, I don't like it personally because I live on 123 Main Street with everybody. But this is an investment show. This is the noon business hour. And from a business standpoint, markets tend to care about the absolute level of spending. They're a little bit less worried about how well balanced the spending actually is. And the spending's been imbalanced for years now between those who are doing so well in the economy and those who are barely getting by, unfortunately.
So that's a sad thing. Even if I'm on the top of the K, I can't celebrate the fact that a lot of people aren't.
Well, you celebrate that markets are all-time highs, but you worry, as do I, John, about the fragility when we are reliant upon such a minority of the American consumer to keep the meals and entertainment and keep the travel and leisure going that powers this U.S. economy.
Okay.
But on the headline news, markets are at all-time highs.
Yeah, well, I'll take high markets, but you were actually writing about consumer confidence. Where is that?
Well, I mean, it depends where you look. I mean, the consumer itself, I have to say, remains relatively resilient despite this elevated level of gasoline prices. And for me, I take my cues from the banks, and we've had bank earnings because, of course, we've had some 151 companies already report, and the banks have shown that even though the high cost of energy is here, it's not curbing the spending that Americans are doing in other areas. But when I look at things about how people feel, that sentiment, very different than data. Boy, that U.S., the Michigan Consumer Sentiment Survey, that's at all-time lows. So survey after survey, sentiment tells me people feel awful. The broad-based data says otherwise based on action.
Yeah, that's how do we reconcile the two? I just want to read from some of your notes. Consumer confidence in April reached its highest level so far this year. According to the Conference Board, the overall consumer confidence index from them climbed to 92.8, up from 92.2. Page 2, the University of Michigan's index of consumer sentiment is sitting at a record low, dragged down by the conflict in Iran. How do those two things exist at the same time?
You know what? It's all about sample size, who you're polling, and what the questions are that you ask. I guess that's the reason the political pollsters get it wrong, too. It's about the sample and the questions you use to elicit the response. What I pay attention to is the absolute trend lines. That's the unemployment data, the inflation data, the economic data, and, of course, the stock market data. That's the ultimate barometer for people's 401ks. But I guess if we bring it all together, John, it's a mixed bag. But maybe that's the reason you and I oftentimes have said the stock market tends to climb a wall of worry, and there's a lot of consumer sentiment that says it's still a wall of worry. Oh, and John, by the way, that consumer confidence board, that's just the best reading so far this year. It's obviously well down from all-time highs.
Consumers generally seem to be feeling better about the labor market. Talk to me about jobs right now.
Well, you know what? The job situation, I mean, we shockingly added, 178,000 jobs in the most recent report that came out. Will it be subject to revision? Of course it will. We'll find out. When I look at the jobs market, I'm sticking to one thing, and I can link the jobs to the feds. The labor market, for me, still remains fragile. There is no doubt about that. We've been in that no hire, low fire mentality, generally speaking, with the exception of this most recent report, for a while. There's no evidence that job creation is really accelerating outside of this one-time report that I got. So I do think as the year continues to go on, the Fed's going to be torn with their dual mandate of maintaining stable prices, that's fighting inflation, while at the same time they're supporting economic growth, which ultimately starts from the bottom up with the job market, which I think is fragile.
What do you think breaks the logjam on that?
In terms of when are we finally going to see a movement? I mean, we're going to have the going away testimony from the current Fed chair that's coming this week. I mean, probably won't be his last public appearance, but he is going to be replaced. I still think there's a reasonable chance of at least a single rate cut coming later this year. And I think it's going to be a decline in the non-farm payrolls that really gets the Fed's attention. And again, if you can get oil prices back down to pre-war levels, unfortunately, stocks are at all-time highs, but oil hasn't confirmed that. Oil's not back to 67 a barrel. Then I think you increase the chances of a Fed rate cut from maybe 30% to well over 50% by year end.
I'm going to ask you the same question about a different thing. The logjam, though, relative to jobs, you said no hire, no fire. We're sort of stagnant in the jobs market. I wonder what's going to change that.
Oh, I think we already know the answer. It's going to change. Unfortunately, I think there's going to be firing, John, coming from the continued deployment of artificial intelligence.
So as long as there's AI, I think jobs are stifled. Job growth is stifled, right?
I think job growth is stifled. If not, job growth is actually threatened because, again, artificial intelligence is just the single largest evolution, if not revolution, since we've seen since the Industrial Revolution. And I just need to come to work every day understanding that nothing is safe. Everything is already changing. Everything will continue to change.
Sure, but that doesn't make the job market better then. That prolongs this or makes it worse, doesn't it?
I think it makes it worse.
I'm looking for some good news here. I said,
well, John, I got good news. I started my opening monologue by telling you that stocks are at all-time highs.
Yes,
Isn't
you
that
did.
Good news?
Well, here, and you also described it as part of the K-shaped economy. So I think if you've got a job and it's paying well, you are doing well. But the person who is going to lose their job or isn't finding that job because of some of the things you've elucidated, then it's not so good, is it?
Lindholm Roofing has appointments available now to provide you a complete roofing, siding, gutter, and tuck pointing inspection. Call 773-283-7675 or lindholmroofing.com. Tell them that Lou sent you. Lindholm Roofing, their family has your family covered.
No, it's not so good. I mean, I acknowledge the K-shaped economy is out there, and I encourage everybody as we go through this cycle, this country, this world that's changing courtesy of artificial intelligence right now, which is completely enhancing the human experience, but it is going to redefine productivity. It's going to redefine jobs. Everybody needs to remain open. Everybody needs to remain flexible and lean into the curve, lean into the trend. Don't pull away from it because you're going to need to embrace it if you want to participate and thrive in this ever-changing economy.
It seems that like a few months ago we were talking about, is this real? Is this a bubble? And maybe then we were just talking about the growth of the stock markets per se. But I think there have been questions about AI and chips and all of these things that are contributing to each other. And we're wondering if that's going to be sustained, if this is going to be its own kind of bubble or blip, or is the world really going to be changing the way we're anticipating? And it seemed like a few months ago we were asking that question. We don't seem to be talking about it in those terms that much these days.
No, we're not. I don't think there's a question here at all. I think all the data points continue to show strength. That's what I call strength in AI, data center-led capital expenditure cycle, and I just don't think it's slowing anytime soon. I would even argue there's some maturation happening, some maturity. I mean, people might not be jumping up and down over the earnings data from OpenAI, but I think it's clearly a sign, if you read the details, that that company is maturing. That company is becoming more independent and willing to expand on its own, as opposed to being reliant upon one heavily domiciled partner, which is Microsoft. We've seen that before in other tech companies, and I think it's just indicative that the future is already here.
Craig Bolanos is on a line on the Noon Business Lunch, the co-founder and wealth advisor at VestGen Wealth Partners. GetRetiredStayRetired.com is the website. I described your conversation with us as being bullish, and I wondered if there were areas you liked for investing money right now. Craig, what do you say about that?
It's going to be some of the same items you and I have talked about so far this year, John. I mean, right now, industrials and financials remain two of the cleanest ways if someone wants to play a resilient economy, and that's what the U.S. is. The economy remains stronger than consensus believes. I mean, those industrials, they're riding a multi-year wave. This reshoring is happening. The infrastructure spending is happening. The defense demand from the defense replacement cycle, all of that's real. And then when you look at the financials, you have to acknowledge they're finally benefiting from higher rates. We've had higher rates for a longer period of time. That screams profits in the form of net interest margin for banks. So I think industrials and financials are where you start. And then people need to get money into two areas that they're all underexposed to: small cap stocks and international investments.
It's been a little quiet on the Iran front the last few days for some obvious reasons and for other reasons that include just nobody's negotiating. But it seems like the markets factored that in and it's waiting for some good news. Is that your take on it as well?
Yeah, I would tell you the market believes that the Strait of Hormuz is eventually going to get open. The markets believe there is eventually going to be a ceasefire, different than peace, once again in the Middle East. And up until there is some shock to tell us otherwise, markets are forward-looking based on where we're going, not just based on the here and now.
Is there any way to read into the markets what the markets think about the timeline of this sort of thing? Is going to be 6 more days, 6 more weeks, 6 more months?
I can't tell you if it's 6 days, 6 weeks, or 6 months, but the market really lays down an intermediate term trend. And I think the market is signaling to us that somewhere between now and the end of the year, there's better days ahead and progress made with Iran. But I wish we could break it down to something simpler. Again, I think the interesting point is that oil prices, that West Texas Intermediate, is still trading $99 at a barrel of oil when we were $67 going into the war. So I don't know if there's going to be a supply shock. I'm not sure if something's coming, but certainly the UAE deciding to pull out of OPEC was very opportunistic and interesting today.
I almost asked you to do a little market timing there too, didn't I? Like 6 weeks, 6 months. The horizon for us investment dollars would look way beyond those data points anyway, right?
Yeah, I think if you're a trader, you're worried about the next 6 days, the next 6 months. You're worried about closing your positions. You're worrying about option contracts. But if you're an investor who wants to get retired and stay retired, you're going to be investing throughout retirement. Yes, that's right. You're going to be investing through retirement because you need to find a way to grow your capital base to continue to grow your income. So it remains a long-term game for all of us when we're being great stewards of our 401ks and IRAs.
But you would definitely approach this market differently if you were 30 or 50 or 75, right?
I definitively would, because once you've made it, once you've secured your retirement, you need to make sure you're in a position not to squander it. Nobody ever wants to get financially secure twice, because if you have to do it twice, the implication, of course, is that you lost it somewhere along the way. Right. That's why it takes a financial plan tied into a strong investment program to make sure that you have an appropriate risk budget. And for everybody else, while you're growing your capital, you're focused on that annual rate of return. But we, too, can all take lessons from what's created security in the past. Globally diversified, multi-asset class portfolios that are regularly rebalanced with strong security selection lead to success over time.
But if you're well into retirement, late into your years, then even though you and I are talking about the upside maybe in this market, maybe that is something you shouldn't be reaching for. Just stay secure in what you've got if you are retired.
I think if you are retired, make sure you've secured your retirement. And that means some of your capital is going to need to be positioned conservatively. But if you're so fortunate, and not everybody is, John, if you're so fortunate that you have enough resources backed by a cash flow and retirement plan to see you through, then some people are actually investing not for themselves. Some people are actually investing for the next generation using their risk budget, and that's a whole other conversation.
Yeah, a risk budget. We'll talk about that next time. Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. GetRetiredStayRetired.com. Okay, Craig, nice to talk to you today.
Thanks so much, John.